Welcome everyone. Before we dive in, a quick disclaimer. This content is not financial advice, it's purely informational. Always do your own research before making any investment decisions. Today, we're going to explore the fascinating world of investments, specifically focusing on two prominent players, stocks and cryptocurrencies. When we talk about stocks, we're referring to shares in the ownership of a company. They represent a claim on part of the company's assets and earnings. On the other hand, cryptocurrencies are digital or virtual forms of currency that use cryptography for security. It's a relatively new form of currency, but it's quickly gaining popularity and acceptance around the globe. In the next few minutes, we're going to dive deep into the top 10 variances between these two forms of investment. So, are you ready to decipher the differences between stocks and cryptos? Let's dive right into it. First up on our list, we have ownership. When you buy stocks, you're purchasing a small fraction of a company. You become a shareholder. This means you own a piece of the company's assets and earnings. It's like having a slice of a giant corporate pie. On the other hand, when you buy cryptocurrencies, you're not buying a piece of a company. Instead, you're purchasing a digital asset that's part of a decentralized network. You own a token or coin, and this token gives you access to a network. For instance, if you own Bitcoin, you have access to the Bitcoin network. The decentralization aspect of cryptos means that no single entity, be it a government or a corporation, has control over the network. So, while stocks offer you a piece of a company, cryptos offer you a piece of a decentralized network. Next, let's talk about regulation. The stock market is a well-oiled machine, operating under a thick layer of rules and regulations. These regulations are designed to maintain fairness, protect investors, and ensure the market's integrity. They're enforced by government bodies like the Securities and Exchange Commission in the United States. Now let's shift gears and look at the crypto market. It's like the Wild West in comparison. Relatively unregulated, the crypto market offers a sense of freedom that can be both exhilarating and daunting. With no central authority to oversee transactions or arbitrate disputes, it's a marketplace where the bold and the brave can thrive. But remember, with great freedom comes great responsibility. The lack of regulation in the crypto market can lead to increased risk, including the potential for market manipulation, fraud, and other unsavory practices. So, tread carefully. Regulation or the lack thereof can significantly impact the risk associated with an investment. Moving on, we have volatility. Both stock and crypto markets have their fair share of ups and downs, but the degree of these fluctuations, the volatility, varies greatly. Stocks tend to be less volatile, influenced by a company's economic indicators and geopolitical. On the cryptocurrencies are notoriously more volatile. This is because their value is largely driven by supply and demand dynamics. Crypto prices can be highly sensitive to public sentiment, technological changes, and regulatory news. A tweet from a prominent figure or an unexpected software update can send prices skyrocketing or plummeting within minutes. Moreover, the relative youth and lack of liquidity in the crypto market can exacerbate price swings. While this heightened volatility can be off-putting for some, it also presents opportunities for high returns for those who can stomach the risk. In conclusion, volatility can be a double-edged sword. It can spell huge profits or equally substantial losses. Next on our list is accessibility. Let's consider the traditional stock market. It operates on business hours, typically from 9 in the morning to 4 in the afternoon, and primarily during weekdays. Additionally, it's often restricted to certain countries, limiting participation to those within specific geographical boundaries. Now let's contrast this with the crypto market. The world of cryptocurrency knows no borders, and most importantly, no business hours. It's a bustling market that operates 24 hours a day, 7 days a week, and is accessible worldwide. This means that you, me, and anyone with an internet connection can trade cryptocurrencies at any time, from any part of the globe. Isn't that liberating? But remember, this round-the-clock nature can be a double-edged sword. While it offers the freedom to trade at will, it also means the market is constantly in flux. The round-the-clock nature of the crypto market can be both a boon and a bane for investors. Now, let's discuss dividends. One of the advantages of owning stocks is the potential for dividends. Dividends are a portion of a company's earnings that are distributed to its shareholders. They can be a steady source of income, especially for investors who hold a large amount of shares in a company. On the other hand, cryptocurrencies usually do not provide dividends. The value of cryptocurrencies mainly lies in their potential for capital appreciation, which means the price of the cryptocurrency increasing over time. This is a stark difference from stocks, where dividends can provide a consistent return on investment, regardless of whether the stock's price increases or not. However, it's important to remember that not receiving dividends from cryptocurrencies doesn't mean there's a lack of profit. Many investors have made significant gains from the appreciation of cryptocurrencies, but the absence of dividends is a characteristic that sets cryptocurrencies apart from stocks, and it's certainly a difference to consider. The lack of dividends in crypto doesn't mean lack of profit, but it's certainly a difference to consider. Up next, we have tangibility. Now here's a tricky concept to get your head around. Both stocks and cryptocurrencies are inherently intangible. You can't hold a Bitcoin or a share of Amazon in your hand, can you? But there's a crucial difference in how they link to the physical world. When you buy a stock, you're buying a piece of a real, tangible company. Its performance, its products, its brick-and-mortar stores. These all impact the value of your stock. You're investing in a company's past achievements and future potential, all of which are very much grounded in reality. On the other hand, cryptocurrencies exist solely in the digital realm. Their value isn't tied to a physical entity, but rather to technology, trust, and the community of users. The value of a crypto is influenced by its underlying technology, its adoption rate, and market sentiment. Both stocks and cryptos are intangible, but their value is derived from very different sources. Let's move on to supply. Now this is a fascinating contrast between stocks and cryptocurrencies. When it comes to supply, many cryptocurrencies have a set limit. For instance, Bitcoin, the digital currency pioneer, has a cap of 21 million coins. Once all of these coins are mined, there won't be any new Bitcoins added to the system. This limited supply can add to the allure and value of cryptocurrencies. On the flip side, stocks represent shares in a company, and theoretically, a company could issue an infinite number of shares, diluting the value of existing shares. However, in practice, companies often buy back shares to increase the value of remaining ones, a strategy that's not really applicable in the crypto world. So, the supply of a financial asset, whether it's a stock or a cryptocurrency, can significantly affect its value. It's a factor that can create scarcity, drive demand, and ultimately, influence price. Supply can greatly impact the value and volatility of an investment. Next, we delve into use case. Stocks and cryptocurrencies have different purposes in the financial world. Stocks represent ownership in a company and are bought with the expectation that the company's success will lead to a return on your investment. They are purely for investment, and their value is intrinsically linked to the company's performance. On the other hand, cryptocurrencies wear many hats. They can be seen as digital assets, a means of exchange, a store of value, or even as a platform for building decentralized applications. Cryptos like Bitcoin were initially designed as a new form of currency, while others like Ethereum support smart contracts and decentralized applications. So, while you're investing in a company's success when buying stocks, investing in a cryptocurrency could mean supporting an entire ecosystem or backing a new form of digital currency. This multifunctionality of cryptos can make them a more versatile investment. So, to wrap up our discussion, we've delved into the intriguing world of stocks and cryptocurrencies, illuminating the top 10 variances that set them apart. We've unearthed how ownership in crypto is absolute, while in stocks it represents a stake in a company. We've navigated the contrasting terrains of regulation, where stocks are heavily monitored and cryptocurrencies remain largely unregulated. We've charted the unpredictable seas of volatility, where cryptos can surge or plummet dramatically, and stocks typically offer a steadier voyage. We've highlighted the accessibility of cryptos, being available 24/7, whereas stock trading operates within set hours. We've tackled the topic of dividends, where stocks may provide a regular income, and cryptos typically do not. We've touched on the tangibility, where stocks are essentially paper assets, while cryptos exist only in the digital realm. We've explored the finite supply of cryptos versus the potentially infinite supply of stocks. And finally, we've examined the diverse use cases each offers. Thanks for watching. Be sure to like, comment, and subscribe. And hit the bell notification so you'll get updates anytime we upload a new video.